It'll be spontaneous.
That opera is.
Oh, okay. Yeah. All right. So, Francis, you want to say a few words?
Yeah. So, no, I don't normally wear a hat backwards inside, but I did visit my friendly dermatologist recently, and he did some things to make me live longer and be handsomer. So I'm sparing you his handiwork at the moment.
And you want to feel cool and look cool.
And that, yeah, I asked my wife this morning, I said, should I wear a hat or not? She said, you look cool in the hat, so why not?
You realize it's backwards.
Sorry?
You realize it's backwards.
Well, that's totally intentional.
Okay. It's a good look.
So, Stephen, thanks for the opportunity to speak today. I will introduce you towards the end. I'm not really here to talk about 1031s because these two people know more about 1031s than I do, certainly, even though if you're keeping score, which I'm not, but I'm sure we're north of 500.
At least 500.
1031 transactions completed. Could even be towards 4 digits. Anyway, but I thought I would share with you some stuff that you already know. And maybe a couple of things that you don't know. But basically talking about, my perception of the market today. I had lunch with somebody from Goldman Sachs, and he basically had the same opening paragraph that I do. So don't expect any brilliant insights. As you all know, we're at a time when there's a lot of short-term uncertainty, which is making a lot of people feel uncertain even about the long term. I'll go off my remarks. I just came from the new museum, which is an art museum downtown, which just tripled its space. And they have an amazing exhibition about how people for the last 100, 125 years, or 150 years, have thought about the future. And it's supposed to be reflecting on how we feel about our future today. Anyway, human condition often experiences anxiety about the future. In the last 100 years, as you all know, there have been many technological revolutions. And of course, we're in the middle of another one right now called AI, which we're all trying to figure out how it's going to impact us, making a lot of people feel like their future is uncertain because their jobs are going to be replaced by technology. And some of them are right, but it doesn't mean there won't be other jobs. Anyway, we have a lot of uncertainty about political instability. At the moment, increasing oil pricing due to the war, and how it will and how that will affect the rate of inflation, and of course, ultimately for people interested in real estate, interest rates. But by contrast, real estate, to me, is fundamentally a long-term business. So I try not to think only in the moment, although that's a reality that we all have to survive, but also to think in longer term than what's the interest rate's going to be tomorrow, 3 months from now, or even a year or two from now. At TEI, we try to buy opportunistically, basically when we feel we can achieve long-term positive leverage returns that are accretive, and then occasionally we like to sell when cap rates are compressed for one reason or another, otherwise known as buy cheap, sell dear. But this is, of course, easier said than done. For us, this discipline has worked throughout our, I'm embarrassed to admit it, 60-year history. And yes, I founded the firm, so I've been around a long time. And our current portfolio includes over 300 properties spread through 37 U.S. states and 7 countries. So we're international in addition to being very widespread throughout the U.S. Being an opportunistic buyer requires us to do what a colleague of mine, Ryan Simonetti, once said, quote, "Don't follow the headlines, follow the trend lines. Don't follow the headlines, follow the trend lines." And what he meant is that often, we're thinking about and informed by, of course, what's happening today. But if you sometimes study the actual data, it tells a different story. So as an example, one of the things that we did in the last 10 or 15 years, we went long in retail. And this was in a time when people thought that bricks and mortar retail was over. So you could buy retail properties at very attractive cap rates, and we bought. And some people thought we were crazy. Yes, I made a mistake in Utah, or I really didn't, because my strategy worked, which is we fully redeemed our investment through the free and clear, but the mall went the way some other malls went. But we own about 125 centers that we bought during the time, which required us to go against the headlines. And we saw various trends that we felt would support retail longer term. TEI is a highly diversified buyer of opportunistically offered properties, so diversification is a fundamental concept for us. By operating through a network of long-standing relationships and joint venture partners in some cases, we're known as a reliable transaction partner with a high certainty of close. Because of this reputation, we're often able to acquire properties from motivated sellers at advantageous prices. We may not be the highest bidder, but for sure we're one of the most reliable. And we pass this pricing advantage on to our investor partners. Today, national real estate markets are trading actively. Because of this liquidity, the kind of opportunistic buying that TEI likes to do is harder, but not impossible. We feel we still source good deals. Financing is plentiful. We're often able to get 10 bids or more on properties that we're seeking financing for. Now I'm going to take you through a few market highlights. Retail leasing opportunities today are at a 20-year high. Open-air strip malls are trading in cap rates between 7 and 8.5 before reserves. The financing market for retail is robust, which is a notable change in sentiment from lenders when compared to the pre- and post-COVID era. Industrial, especially small bay, are also at very strong occupancies and trade in similar cap rates of, I would say, 6.5 to 8.5. Some larger bay markets, particularly in newly built products, are experiencing some downward rental pressure due to excess supply. Not all, but some. In many cases, the price per square foot of industrial properties exceeds office pricing. It's the world upside down. We tend to stay disciplined in our acquisition pricing, and recent purchases have been under $60 a square foot. However, in some markets, especially coastal ones, it is not uncommon to see prices per square foot that are 3 times that price. And replacement costs are probably in that 3-time range, if you consider building costs and land. Residential and multifamily buildings have very limited availability and are typically trading between 4.75 and 6% cap rates. And while we begin to see multifamily, particularly in places like New York, not pre-market, but stabilized buildings where increases don't keep up with expenses, some of which were bought or developed at low interest periods. When they come up for mortgage renewal, the new mortgages in some cases are sizing lower than the old mortgage because rates are higher, and those developers are basically forced to sell because they don't have the new equity that would be required to fund the pay down of their old mortgages. And although I'm New York City shy, their cap rates in that type of property have expanded dramatically relative to the difficulties, the economic irreality of our rent laws. Office remains mixed. Underoccupied office buildings are often trading at 10-plus cap rates on existing occupancy, and you sort of get whatever's vacant for free. Per square foot prices are somewhere between 25 and 50% of replacement costs. I was just talking with Nikki about a building we bought in Denver, just a million feet. Last traded at $180 to $200 a foot. We bought it for $47.50, or 25% of the last price that it traded at, and a very healthy cap rate, about a 12% cap rate on the existing occupants. Outside of what we regard as primary real estate asset classes, there are very big bets being made on relatively new asset classes, such as data centers, where billions of investment capital are being spent to acquire land and develop these properties. These assets may turn out well, but certainly carry a degree of risk due to their special use nature. Technological innovation, ironically, and this would be disputed, I'm sure, by people who know something, I don't know anything, could be disrupted if somehow they can figure out how to power AI chips with less power, right? Since they seem to think of everything else in the world, why wouldn't they do that? In which case, data centers, even though they're typically under leased, they're under long-term leases to very strong credits. On a more mature asset class, such as student housing, we're still seeing very competitive pricing at the top-tier universities across the United States. But there are questions of how technology will impact many of these schools over the next decade. So we're being cautious on pricing and spending a lot of time making sure that the university where we buy student housing is well funded. Generally, I tend to prefer state colleges, thinking that they offer students the best value proposition. So they'll be less likely to pressure as student enrollment changes. So just to summarize, over the last 15 months, we've acquired 18 separate operating properties in 13 states and 3 different countries. 5 retail properties, 4 industrial properties, 4 office properties, 2 residential properties, and 3 properties in Europe, 2 office buildings, separate transactions in Glasgow, Scotland, and 1 building in Holland, where we have a very large portfolio already. As part of the 2 residential properties above, we recently completed development of a 74-story, 738-unit luxury high-rise in downtown Chicago on Michigan Avenue, and are now in the process of building the first phase of a new development of 900 units in Palm Beach County, in the town of Boynton Beach, which is just south of West Palm. Typically, development properties carry a higher risk than income properties, given all the different variables. However, because we're able to buy land sites advantageously and opportunistically and take them through extensive rezoning, we're often able to acquire things at advantageous land pricing. As I mentioned, one of our primary investment philosophies is to remain very diversified geographically and by asset class. And in order to do this, we have an extensive portfolio. An extensive part of our portfolio is in Western Europe. We avoid countries where we see political risk and just stay to those places where that's not an element. Germany, Holland. We had an adventure in Italy. I don't recommend it. Great Britain, Scotland, etc. So that's a little bit about us and how we think. Nothing revolutionary, but it's what we do. On today's panel, you're going to be treated to a very high-level discussion of 1031 transactions, which facilitates many of the investments that TI makes, both for its own account and those of our third-party investors. Both Lou Weller and Steve Breitstone are the best in the business and highly regarded tax attorneys who've been very helpful to us in expanding our 1031 exchange business. David Becker and I have been hanging out apparently for 25 years. I remember him when he was younger. And he's one of our leading executives and has developed some very strong financial relationships that are important to our firm. Unlike some 1031 investors who attempt to transition from operating properties to a more passive net lease type of properties, TEI feels that net lease returns do not properly reflect the longer-term reality of vacancies, leasing costs, and capital improvements, because they're often underwritten as 100% occupied properties that are going to send you checks forever. Well, even net lease properties, lease might be 10 years, might be 15 years. One day it ends, and then you're going to face the realities of the real estate business, or the tenant's going to go BK, and then you'll face it sooner. Net leases, I'm sure you will hear more about creative structures that have enabled our investment partners to use gains favorably and for their diversification for future generations. That's what we all collaborate on continuously. By contrast to net lease properties, when we underwrite operating properties, TEI accounts for factors of vacancy, leasing costs, capital improvements from day one. And therefore, we think the pricing of operating properties is much more durable and realistic. Of course, the factors that impact real estate are endless, and one needs to try to stay ahead of issues like rent regulation, property taxes, climate change, insurance costs, local economic cycles, and regional supply and demand. We're all also entering the era which we talked about with the increased use of and reliance on AI, and we have to think about how that's going to impact real estate as well. We have 8 teams of exceptional acquisition asset managers and professionals who follow these issues in all the markets that we participate in. When I personally invest in non-real estate equity markets, which I do extensively, I do it through highly skilled fund managers. I don't try to navigate the world of private equity myself, or even the world of stocks, publicly traded stocks. I have an expression that says, I don't bet on horses, I bet on jockeys. And just to say that I think the TEI is an excellent jockey to partner with when making real estate investments. So thank you all for listening. Turn it over now to people who know something.
All right. Thank you. So there's a lot out there, a lot of different types of properties. And the question is, how do we get into those properties with 1031 exchanges? So we're going to try to talk about some of the things that are out in the marketplace, some of the pros and cons. But the key is that you can only do a 1031 exchange for real estate. And there are lots of ways of packaging real estate, of dividing up the pie, so that you can participate in real estate. I would say that the biggest challenges are to find a way of leveraging off of good management, good quality properties, not to trade into something that's inferior to what you've been giving up. Everybody wants to trade up if they can do it. And then there are the challenges of implementation. So there are different structures that address the concerns about timing, about liquidity. I mean, a lot of people, they don't want to just roll all their money into another deal. There are techniques out there to get some cash out of a 1031 exchange, leveraging up. There are some very, I would say, dubious legal structures out there. You've got this is not for the faint of heart. There's a lot of product out there that, my family did a 1031 exchange about 2 years ago, and I had the privilege, aside from all my experiences representing clients, of actually reading the materials on some of the product offerings that are out there, and it's a little bit scary when you think about things that come out in a nice shiny package, thick book, a lot of words, and don't assume that things make sense. So, with that in mind, let's just run through some of the menu of structures.
It's a question that comes up all the time, and I get being the West Coaster and the farthest one away from Washington, D.C., that makes me the most qualified to comment about the future of 1031, which everybody is concerned about. And I'll say something I've said periodically over time: exchange now, because this is a code section which has survived attempts to repeal it for many, many years. And one thing everybody should know is we are the only country on the planet which has what we call 1031. No other country allows people to sell property and buy replacement property and not pay tax on the sale. So as a matter of world tax policy, you have to understand that we're unique. And that's one, and as you all know, we're getting more global. The effect of other tax systems is going to, over time, have more of an effect on our tax system, number one. Number two, it's very politically driven, and we're seeing potential change. One thing, there will be no changes in the current Congress. That's pretty clear. What happens when a new president is elected, when a new Congress elected, is anybody's guess, because there are forces that have been trying to repeal Section 1031 for many years. They've generally been rebuffed over time, but it's getting closer. And so you can't assume this code section will last forever. It might. I've spent a career doing this. I've been in this longer than anybody except Francis at the table. My first 1031 work was in the late 70s. I actually worked on the Starker case. With those of you who may have heard of it, it was the case that established the ability to do deferred exchanges. So I've been living with this code section and writing it for a very long time. It's been good to me, but I'm not expecting it to last forever because it is an anomaly in the world taxation system. It won't take away if they change it, it won't eliminate the deferral you've gotten along the way, which is why I say exchange now and take advantage of the current rules as much as you can, because they may not last forever. On the other hand, exchanging now will be easier in the next couple of years because nobody is left at the Internal Revenue Service to supervise or audit this stuff. You've all been reading about the huge numbers of departures from IRS, the firings of people on the enforcement side, the firings of people who aren't friends of the president, the retirement of major talent. It's happening in Internal Revenue Service like it's happening a lot of places. And that talent is not being replaced. So the ability of the government to audit these transactions and challenge things that are aggressive is going to be harder and harder to do. And you're going to have to make your own decision about how far outside or inside the envelope you're willing to go. But I think it's going to make it harder to justify not being outside the envelope given the lack of audit. I'm not supposed to say that as a tax lawyer, because I'm not supposed to advise people on the risk of audit, but let's face it, it's real, and any businessman is ridiculous not to take that into account in making decisions about what to do. But be aware that that can all change. Congress changes, the administration changes, money is poured into IRS for enforcement and other things. The current posture may not look the same in 5 years, 4 years as it does today, and we have to take that into account. With that, we'll talk about some specific things, and I'll give it back to Steve.
Well, while you're at it, I have one. While you're at it, what do you think about AI? Will the IRS take advantage of AI to audit these transactions?
Do they have the capacity to do that today? No. Will they ultimately have the capacity? Absolutely. I mean, I think all of us, a lot of gray hair in this room. I feel at home. And I think we all realize that even if our gray hair is preventing us from becoming really familiar with AI, it is the future. And there's a gentleman here, I think, who works for a company involved in AI, and I come from California. I deal with a lot of high-tech oriented people, and this is the wave of the future. And it's the wave of the future because people in their 20s and 30s are embracing it. You may not be embracing it, but the younger generation is embracing it, and that's why it won't stop there. It will move into the government ultimately. How fast, I don't know, but I don't think there's any way around that.
Let me make one comment on AI. I'll tell you what's interesting about the AI thing is that if you're a licensed security professional, so we have Time Equities Inc. and then Time Equities Securities. But the Time Equities Securities folks aren't allowed to use AI in a way because their controls aren't yet set on client protection. So FINRA's position basically is that they're not comfortable with us using certain AI metrics in our software programs. And so that creates a whole nother dynamic. If you have the IRS coming in using AI and the people that maybe they're ordering, a large part of this 1031 business comes from the security side. So it's just another complication of something we don't fully understand.
Of course, those of you who like reading apocryphal stories, there's a very well-known popular book called If They Build It, We Will All Die. And the premise of the book is if super AI is developed that can replicate itself, then we're into the world of the Terminator. So the world of the future and the world involving AI is one that we're all going to watch, me not as long as many of you, but it's going to change everything, and I don't see any way to stop that.
Yeah. At this point, I'm seeing a lot of use of AI in the practice of the law. There are a lot of concerns about it, including confidentiality, which is a big one. But the biggest concern that I have, it's almost as radical as when I first started practicing, which would be before PCs. And everybody was afraid if we're going to have PCs creating our documents using forms that are on a computer, that people will stop thinking and they'll stop reading the documents and they'll make a lot of mistakes. And obviously, the volume of material that we have to go through today is so much greater than it was back when I started practicing law because there's so much more material produced. AI is a tool that can be used to sort through that, but my experience is that it's not a substitute for thinking. It is not a substitute for what we do. It's like reviewing the work of a junior associate. They may have a lot of great thoughts, but they miss the big picture or they miss some of the critical issues, and we still have to do our job. Will AI get to the point down the road where they can do more and do it better? Perhaps. I think we're a long way off from that for the types of things that we do. I'm not saying there aren't a lot of routine tasks that AI cannot do, but I think that for what we do as legal professionals, I think that it's very early in that process. So, anyway, yeah.
Just one comment. The Internal Revenue Service has been using versions of AI for many, many years. Their discriminating analysis programs are designed to try to identify for them high audit risk tax returns. So they feed information into programs that are basically AI. They're designed to think about what is associated with this tax return that gives rise to a potential audit flag. And as AI improves and gets much more sophisticated, that is only going to expand and generate more, if there are people to do it, more enforcement activity. That's the tension right now, is the technology is far outpacing the number of people who can use it or work with it.
Now, so I'm going to introduce the topic of, what are we doing here? Why do we do 1031 exchanges? So with a 1031 exchange, we're rolling over our profits into another property. It used to be you could do it for other things, not just real estate. You could do it for equipment, for goodwill, a lot of different types of art, a lot of different types of assets.
Or
Oh, we did a lot of
it's
Everglades.
very popular 1031.
So in 2017, when the Tax Cuts and Jobs Act was enacted, they eliminated 1031 exchanges for everything except for real estate. By the way, you used to be able to do real estate for partnership, 1031 exchanges for partnership interests. You can no longer do 1031 exchanges for partnership interests. So a lot of the planning that we do is to try to create a scenario where you can take some of the advantages of a partnership structure, but it's not a partnership for tax purposes. So I'll get into that in a minute. But what we're doing, what our clients do, looking around the room, some of them are sitting here, is they want to grow the value of their real estate. They want to pull out some of that value periodically through financings, because financings under our tax system are not considered to be income. Financing proceeds are not considered to be income. And that's deeply embedded in the constitutional underpinnings of the income tax system. So that's not likely to change anytime soon. But so it's the ability to pull out cash, buy other properties either with that cash or just pull it out and do other things with it. There are some negative tax consequences when you extract cash from a property and don't reinvest it in other real estate, like the ability to deduct the interest can be challenging and the like. But the main point is that over time, people tend to build up the liabilities and not necessarily increase their basis in the properties because they're not paying their tax. In order to get basis, you typically have to have gain recognition and pay a tax, or redeploy capital into the real estate. So what is a 1031 exchange in the long run? It's a bridge to getting a basis step up. And we do a lot of wealth planning at our firm. So I just want to make sure not to omit this critical point, which is that when you transfer assets into a trust, when you transfer appreciated real estate, encumbered appreciated real estate, into a trust, and that trust is not a grantor trust during lifetime, upon death, that means that it's a disregarded entity. It's completed gift. It's usually a completed transaction for estate and gift tax purposes, but for income tax purposes, it's ignored. It's as if you still own the property. On death, the trust stops being a grantor trust. And then the question is, what happens then? If you've transferred the appreciated real estate with encumbrances, with liabilities typically in excess of basis into the trust, and you die, there's no more opportunity to get a basis step up on that real estate. And that's a critical flaw in what a lot of people are doing. So you have to keep in mind, it was unclear, right? An irrevocable trust that becomes a non-grantor trust upon death, because the powers that make it a grantor trust tend to go away upon death. They do go away on death.
Steve, can I hit on that for 1 minute?
Yeah, sure.
So I come at it from more of a deal point of view, or a deal person point of view, and also the liaison between our investment base and management or acquisition people. But my team and I would say, get a call weekly or more from large family offices, investors, where the patriarch or the matriarch is ready to step back from the transaction, has a lot of their family's net worth in one consolidated or two consolidated assets, and it's time for them to sell, and they want to see through the whole exchange, but they don't really understand it. They have a lot of financial advisors coming at them with a variety of different options, and they don't really understand exactly all the benefits that you can do with, like, let's say, a custom scenario. So, like, on the basis, if someone is all cash, what we would typically do is put them into an all cash. I'm oversimplifying, but put them into an all cash transaction. And then at some point, a year later, or whatever time is appropriate, put financing on that property, and then they would be able to reinvest those proceeds in whatever manner they liked with a new basis. So they really accomplish like two primary functions. They get a significant amount of diversification, new tax basis. And I guess a third is, in some ways, they can take the timing of the transaction out of the equation, which ends up being one of the biggest hurdles that we see. So many families sell properties, have set timing on a sale, might think they're going into another property, but they misjudge going into the new property. Some of the things that might come up during due diligence or closing or whatever it might be. And there's this window of time. It's a 45-day window from the day you sell to designate a new property. And so I find that coming to them with this sort of wholesome solution of, well, you got to first take timing out of it, then in a more structured way or with some thought, carefully thought out strategies, put some financing on it, redeploy into a range of new things that are not correlated together. New tax basis starts on that money. So that becomes a big advantage. So a lot of things can happen from one transaction that leads to a whole bunch. And so I think we come at it a little bit differently in the sense that it's this custom scenario where we can take one concentrated amount and actually provide some diversified tax-friendly scenario where they're able to sort of spread it out. And that's been very successful for us, just in speaking of all these tax issues and how they get the benefit of liquidity, diversification, all these things. It's been a useful tool for us.
It should be noted that when you do pull out the cash and redeploy it, you do get fresh basis, and that can create a lot of opportunities because fresh basis means you can create depreciation deductions, which shelter the income from the replacement property and also the income from the property that you borrowed against to generate the proceeds. So there's a lot of management of a portfolio when you've done a lot of 1031 exchanges, because if you don't do this management, you can have a lot of phantom income. You have leverage on properties. As debt gets paid down over time, what's it getting paid down with? Income. So you have rental income coming in. And if you're not generating more depreciation, and that's a big part of this process, is managing it so that you can continually generate more depreciation, more shelter. Otherwise, you're going to have a lot of tax on what we call phantom income, which is income that you do not receive because it's going to pay the lender. It's going to the bank. So when you have a big 1031 portfolio, I've had clients with huge 1031 portfolios, managing the phantom income is a huge part of the process. But again, it's getting that bridge to a basis step up. All of the planning has to be around eventually getting a basis step up upon death, which is the freedom to get out of from under all of this, all of these negative income tax consequences down the road. So, and I'm just going to say this again because most people do not realize this. If you transfer the assets, the real estate into a trust, and it's an irrevocable trust that's a grantor trust, there's no tax consequences, income tax consequences when you transfer the assets into the trust. But upon death, it ceases to be a grantor trust. And then you're trapped. Those assets will have, there's some people that think that could trigger all the gain. I don't think that's the case. But those assets in the trust no longer qualify for a basis step up. And that is a relatively new development, meaning some people thought that it did. I know a lot of my estate planning partners, some of the ones that are no longer at the firm because they've aged out, believe that you did get the step up, but you don't. And the service ruled 2 years ago that there is no basis step up on these assets inside of a trust upon death, once it no longer is a grantor trust. So you need to plan around that. And that planning, I'm not going to get into that today. I could spend hours talking about it. But that planning is to keep the liabilities in the hands of the of the taxpayer, of the client, but transfer equity only into the trust. Because it's the liabilities, if you get a step up in basis on the liabilities by including them in the estate, you get an income tax benefit, an enormous income tax benefit, and there's no estate tax cost to having debt. In fact, it offsets the values that would otherwise be subject to estate tax. So there's this balancing that we do. It's not, it's not always apparent, and a lot of people overlook it. So that said, let's talk about some 1031 structures. So one of the most popular techniques that we see are tenancies in common, right? So what's a tenancy in common? It's co-ownership of real estate, but it's not a partnership. It has to be structured so it's not a partnership.
And it can be. One thing you have to remember is that the label co-tenancy or tenants in common or undivided interest does not dictate the income tax consequence. The tax law is clear that if you're a partnership, because you share profits, that's the definition of a partnership, sharing profits and losses, then whatever you call the way you hold property doesn't mean that you don't have to, that you're not a partnership for income tax purposes, which means people's interests are partnership interests, and they can't do 1031s into or out of that entity. We spend inordinate amounts of time trying to avoid partnership characterization on arrangements that are denominated tenancy in common interests. And I just wrote a very large tax opinion for TEI in which that's the main objective of the opinion, is reaching a conclusion that the relationship of people who are called tenants in common, no question about it, isn't a partnership for income tax. That's a question in every transaction. We're trying to avoid partnership treatment because typically you've got people bringing capital. The general topic we've been talking about is how to assemble multiple people's capital into a single investment. They have to have a group vehicle to do that. And what Steve is mentioning is the group vehicle that's most 1031 friendly. There's another one, which we'll mention, Delaware Statutory Trusts, but one that I think all three of us believe is the most taxpayer at the end of the day friendly is the tenancy in common structure. And why? Because individual, for tax purposes called co-owners, are regarded as directly owning their fraction of the underlying real estate. Your undivided interest, whether it's 1% or 50%, is still treated as real estate. That's not true of partnerships because you own an interest in a partnership for tax purposes is not real. So the other thing to remember is everything we've been talking about deals with ultimately individuals. The interest, the basis step up and all that has no bearing on entities. Well, you say, well, why would entities ever do 1031s? Entities do massive amounts of, every REIT has a very large 1031 program. Why? Because of the deferral of tax on the sale. You're getting a net present value. The way we compute the benefit of a 1031 is the NPV, even where you're going to pay tax. We don't assume a basis step up because you're a REIT or an entity. You have a positive NPV of saving the tax today, reinvesting the money you would have paid the government in the tax today, and not paying it for many years, even if you're going to pay it in the future. That's the fundamental economic rationale for doing 1031 exchanges, even where basis step up is not going to eliminate the gain in the future.
When you say entities, you mean non-partnership taxed entities, right? Partnerships
can and do exchanges all the time at the entity level, and they're eligible to do that. REITs do that. C Corps do it. I represent a very large Hawaiian enterprise which operates in a C Corp because historically, corporations, by the way, in the real estate area are like the cross in front of a vampire. You don't want to use it. You don't want to use them. But if you're stuck, how many of you have ever dealt with S Corp real estate? S Corp real estate is a big bugaboo in the 1031 world. Why? Because you're inside a corporation and you can't take property out of an S Corp like you can a partnership without triggering tax. There's a code section that says you have built-in gain, your value of your property is more than your basis, and inside the S Corp, you distribute it, you trigger that gain. So we do all kinds of planning around how to avoid that particular treatment and still get separation among shareholders. It's a whole topic. And Steve could talk for an hour about estate planning. I could talk for an hour about the S corps, as can Steve. But remember, all these things are playing a role. 1031 is an internal revenue code section, folks. That means the tax law governs how it works. People get, upset by us tax lawyers telling them you can do this, you can't do this. Well, we can't help that because you're trying to stay within the boundaries of what a specific Internal Revenue Code section unique to the United States allows you to do. And even more, and it's important to understand that, and because you'll get pushback if you try to escape it, 1031 is an unusual section in that it totally turns on its head the normal tax. You've all heard the term in the tax world, substance over form. It's a mantra in the tax world. You can't avoid things by simply doing a certain form if your substance isn't consistent with that. Well, 1031 is almost the opposite. 1031, you follow form and you get the result you want. So it's critical to understand the forms that are allowed and aren't allowed to do these transactions. And that's what Steve and I spend our days doing. And David and TAI, are listening to us, and we collaborate and trying to accomplish these things so that the forms don't impede the business deal. That's a critical element to this planning, is how can you be consistent with the form? How can you be consistent with the very rigid rules and still accomplish the business goals you're trying to accomplish?
Form really matters. Yeah, and by the way, people feel free to ask questions. I should have said that earlier. But
how may I get closer?
I'm not personally aware. I mean, every tax publisher is knocking on the door of every tax practitioner trying to sell their AI, application. How far they've gotten, and I've seen some of it, and some of it's decent, but how far they've gotten in really doing the discriminating analysis that I mentioned the Internal Revenue Service has historically used, I can't say. And I'm the wrong person to ask because I've got too much gray hair. There must be some younger people who might be able to answer it, but
not that much, but I'm younger. Not that much. So far, what I'm finding is the AI applications that the tax publishers have come out with are mainly a way of aggregating the data that's already out there. They don't come up with new ideas. So it's a way of expediting research. You find things that are out there, you find an article, you find a case, a ruling, and it can be very helpful in locating things, but it's not really going to do an analysis that's what we could do.
I've seen some AI responses to tax questions, and they've generally been wrong or misleading. So at least at present, it does not appear to me that they're far enough along to rely on. But I see that changing. That world is changing very rapidly.
The articles from the tax advisor, for instance, a lot. So you write an article, bootstrap your way into.
You'll find that article a lot faster with AI than you will by digging through books.
Yeah, and the question is whether at what point will AI replace Steve and I in terms of we don't go to secondary sources. We try to take the Internal Revenue Code or regulations and interpret them. AI has a limited ability so far. Another question.
AI hallucinates in the retail form, which is why it would give you misleading and misrepresenting fact. However, when you go a higher scale version and give it, it's only the dictionary of the code, you actually can get an agent bot that will actually reason and find solutions to complex problems. It's just not mainstream this year. I think in the next 48 months, it'll be rather remarkable what you're able to do. That's for one eyes.
I don't disagree that this is a world that's changing very, very fast, and it's improving very, very fast. And so I think we're within sight of much more robust, much more effective AI. But today, I haven't seen it as accurate as we need it. You need it to be to rely on it.
I'll add a comment about that. I mean, a lot of what I do is handholding. So, thanks. A lot of what I do is handholding. So, what these gentlemen are very good at is, first question I ask one of our investment clients is, what are we trying to solve for? What are your objectives? Same way a financial advisor would ask in a wholesome way. Once you get that and you actually try to figure out, well, here's what they're trying to accomplish, big picture, then you can call these gentlemen and be like, how do you navigate through that to get from point A to point B? And I would say that's probably the number one value that a real estate investment firm can bring to anyone in these circumstances, because it's a back and forth. It's a fluid. I guess you can have it in part with AI. We haven't had experience with that yet because it's very personal. There's family members involved. Some don't get along. Some are trying to deal with other family members. And it's this whole storyline. So to me, it is actually substance over form.
It may get there, but it's not there yet. So as to ticks, let me move on from ticks, but briefly I want to say one or two things. There is an IRS revenue procedure which lays out the ruling guidelines for when something is a tenancy in common rather than a partnership. And we try to adhere to that substantially, but you don't have to adhere to it 100%. It's just IRS ruling guidelines. And
There's a lot of misinformation and misunderstanding about the scope of that particular release, which is, for those of you who want to write it down, is 2002-22. But more importantly, about a lot of things involving 1031. And there's sort of the stories among people that think they know, and then there's the real truth. And that those two aren't always the same. I see it all the time. All the time.
All right. So one of the biggest drawbacks to a tenancy in common structure is that there are multiple borrowers, and lenders hate tenancy in commons. And it's always a fight. How many ticks are they going to allow? And they don't want to have multiple defaults, and multiple bankruptcies. It can be very hard for them to collect. So another structure has evolved in the marketplace, which is owning through real estate through a Delaware statutory trust. I mentioned before grantor trusts, right? It's a disregarded trust for income tax purposes. A Delaware statutory trust is essentially a grantor trust. It's one trust that owns one property typically, and it can have many owners. So they fractionalize it. They sell off shares of these Delaware statutory trusts, and one lender. So the lenders are much happier with them, even though they have many owners, many participants.
The owners don't have any power. A DST is a trust with a single trustee who controls everything. Unlike a tenancy in common, what are called BIOs, beneficial interest owners, who are the owners of interest in the trust, have no say in anything related to the asset. They can't say anything about when it's sold. They can't say anything about when it's financed, although you can't really refinance it. You can't say anything about managing the property, on and on and on. So it's completely passive as far as the interest holders go, but they are regarded, just like TICs, as having a percentage of the property for income tax purposes. That's what gets them 1031 qualification. You buy an interest in a trust, you don't own real estate, but the tax law says you do. The tax law says you can acquire wholesale property, and then you can trade out of it.
There's billions and billions of dollars being raised in the DST space now. There's a clear pro to the TIC structure because you're owning real estate traditionally how you would own it, which means you can all the advantages of being adaptable, flexible, financing when it's creative, when it's appropriate to finance, renovating, repositioning, re-tenanting, all the things that actually, to me, matter. So it gives you much, much more flexibility. Whereas the DST...
An opportunity to participate in the upside.
Correct.
And DST does not really afford you.
Right. So what you go into a DST And although they're a lot easier for Wall Street to position and send out massive amounts. I mean, there's probably, I don't know, 5 billion raised this year on DSTs. And it's just a number, but like because all the big boys are in it. And so, but the ownership itself, you have very little variability on what you can do. And if something goes wrong, you really have no move, and you're typically not aligned with the sponsor because they really can't participate in the profits. So it's a tricky. Go ahead, John. It's a tricky.
If there's so much focus disproving a tick as a partnership, what's the reasoning? What's the logic behind the DST not being considered a partnership? Reason.
The Internal Revenue Service issued a revenue procedure in 2004, 96, that said if you put your trust together in a particular way and there's deadly sins that the trust can't commit in order to qualify under this regime, we will treat the trust, as Steve said, as a grantor trust. And like with other grantor trusts, the estate planning grantor trust that you're used to, the ownership of the assets in the trust is regarded as directly, for tax purposes, owned by the trust beneficiary. So that's why people do it. The problem with DSTs is you couldn't do them for most of what the kinds of property that TEI does. You can't do them for opportunistic value-add property because the trust, because it's got to be frozen, can't do significant improvements to property, can't refinance property, can't deal with a property that has multiple tenants changing over. There are some solutions to those things, but DSTs, and I agree as an economic matter, but not as a technical matter, that you don't get a lot of appreciation in DSTs because you can't add value to the property. So the only way you're going to get appreciation, which you can get, the law doesn't keep you from getting it, is just market appreciation. If the property you buy increases in value, the beneficial interest will share in that increase, less whatever costs that they have. But they can't create extra value because they're not allowed to do the things that would create extra value, like re-tenant the property under the DST rules. Yeah.
In a grantor trust, they're very sophisticated. You have dynasties, you have digits, you have all kinds of grantor trusts. You have passive entities that are owned by trusts and active entities. So why would you say that it's not able to be re-tenanted in a...
Because they have a revenue procedure that gives the disregarded treatment to a real estate owning Delaware statutory trust, says that we won't treat a Delaware statutory trust that where the trustor is. It has to do, there's a tension, and the tension is between entities that conduct business operations and file income tax returns reporting those operations so that the government could look at them and assess them, and non-entities that don't file income tax returns. The DST and the TIC, tenant and common structure, do not file income tax returns at an entity level. Income tax reporting of properties held by those vehicles is at the individual ownership level. Well, guess what? That creates all kinds of opportunities for games playing by different owners of the same property with the same activity that want to report things differently. The government doesn't like that, legitimately so, frankly. So it wants to limit the opportunities for people collectively conducting business and not filing a collective tax return. That's the reason.
If you commit one of these so-called 7 deadly sins in a Delaware statutory trust, it will not be considered to be a grantor trust for income tax purposes. Probably treated as some sort of an association, taxable as a corporation, and then you don't get the 1031 treatment. You don't get, you'll have a separate level of tax. It's a disaster. And so we can use grantor trusts for a lot of things, but if you're going to own real estate in a grantor trust and you want to get 1031 treatment, you have to comply with with these very rigorous rules. So that's the reason. Okay, so next, there are structures that you can invest in as an interim step, as a tenancy in common, or as a Delaware statutory trust. And then after a period of seasoning, you'll be given the opportunity to roll it into a REIT, an UPREIT transaction, and what we call a 721 transaction. So what do you think about those? Lou, you have any thoughts about those?
Yes, conceptually that should work. I say that because I was one of the people who did some of the first of those transactions. But we hear the term 1031 721. And that's because the two relevant code sections are the 1031 you do to acquire an property, and the 721 code section 721 transactions you do when you contribute that interest to you wouldn't be contributing, by the way, to a REIT, which has to be a corporation or a trust. You're going to contribute it to what's called an operating partnership, or OP, which the REIT owns and is a partnership for tax purposes, and you get the 721 treatment that you need to go into the investment tax-free. And I think they work just fine. I've done it for 15 years. The news, and they become very popular. And all wirehouses are offering vehicles of this type.
Yeah, I mean, I'll just say from a business point of view, because I've been talking to Francis about whether we should be considering some vehicle that would allow a certain amount of our properties, or maybe it was a particular property or two or three that came in through 1031, but where we uprooted them. The advantage would give the next generation some liquidity, because they could, in theory, sell some shares of the REIT. That's really one.
And diversification.
Right.
The reason you go into one of these deals is because when you go into a partnership, it's going to have additional property to the one you're putting in, and you're going to diversify.
Right, but I would tell you that you get diversification in a better way with us in the TIC structure. So, meaning you can accomplish that objective through financings and reinvestment, et cetera.
It's hard to do an exchange out of such an arrangement, though. Once you go in,
That's true.
then you're kind of stuck with it.
But
Hotel.
my point is that
You can't.
my point is that the primary issue that we face as an investment company is when investors want liquidity, and call it a non-liquid asset, and then we have to sort of price it and deal with taking them out, and whether it's internal entities or an outside entity. But that REIT structure does allow for some liquidity to the next generation, or they can take it out and pay tax. Some people just need money at times to relate to their family. So unless it's the next generation, then they get the
Or to
step.
hold it until death and get a
Hold
step.
it till death. So it is used by older investors who are thinking about giving their kids some optionality about being able to have liquidity at some point upon their death, without really being subject to what the sponsor says. So there is that clear benefit. But there's negatives to it.
All right. Now, one last topic that I want to cover, because we're kind of out of time. Tax Cuts and Jobs Act 2017. We dodged the bullet. The proposals were to repeal 1031 altogether, but to allow everything you buy to be expensed. So if you can expense your replacement property, what does it matter if it's a 1031 exchange? And that didn't quite get passed, but bonus depreciation did. So on tangible personal property, they enacted at that point 100% bonus depreciation. So the thought was, you sell your airplane, you have your gain, you have your recapture, but then you can take bonus depreciation if you buy another airplane and offset the gain. And that was gradually phasing out over the last several years. The OBBA, whatever act.
Beautiful bill.
Yeah. I have trouble with that one. Anyway, reenacted bonus depreciation. So it's now 100% with no phase out. And that in order to qualify for bonus depreciation, only certain types of property qualifies, and it can apply to some real estate, but you have to have like building improvements, things with a class life of 20 years or less. But then they enacted something called, qualified production property. which allows 100% expensing of certain types of property that's used in production, and that can include buildings and real estate. So that's going to be a big thing in the future as
Oil manufacturing facilities.
There's certain things I was told
Top secret.
yeah, no, Lou doesn't really love me talking about.
he'll tell you, but we're going to have to kill you.
Talk about that.
Yeah, talk about it privately.
But it is a planning technique people are using now. And by the way, the economists love the concept. The economists were behind the attempt to repeal 1031 because the theory was, as an economic matter, if you can write off the cost of a replacement property in the year you buy it, you don't need 1031 because it'll just offset the gain you have from what you sold. The difficulty was that they were getting rid of the full write-off, and it doesn't work if you do it in a different year. You better buy the new property in the same year you sold, or you're going to have a mismatch. Tax in year one, deduction in year two, with no ability to carry back the deduction. So you've got a real deduction going into the...
Right. They also
We'll say that it
eliminated
works
carry-
better as a value add type property.
Yeah.
So we're doing tenant improvements,
That's right.
leasing costs, and construction. So there's actually capital being spent.
We see a lot of bonus depreciation.
You're
We
able
claim.
to like
Bonus and bonus depreciation only apply to certain investors. If you have an LLC and a passive investor, you may not be considered allowed to take that bonus depreciation over the LLC.
No, passive investors may be subject to the passive loss rules on all losses, not just bonus depreciation. So that's an overlay of all of this that you have to take into consideration, whether you qualify to take the deductions under the passive loss rules if you're a real estate professional and the like. Those rules are very complex. Yes.
And if you go relate it with Series LLC and throw in some partnership law, what hell of a great tax strategy is going to behoove any IRS agent. But
Even the AI IRS agents. So, all right. Well, if there are any other questions, anybody have a question before we wrap it up?
The speakers will be here for a while, so feel free to come up.
Yeah, we're gonna feel free to stick around and have another drink,
Yeah.
mingle. We're gonna be here for at least until 8 o'clock. Thank you for coming.